Today I would like to analyze Texas Roadhouse, one of the largest steakhouse chains in America. The stock had a very good performance in the last 5 years. It's up around 153%, but in the 1-year chart we can see it's down around 20%. So we're gonna take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 10.82 billion US dollar. This makes Texas Roadhouse the 8th largest restaurant company in the world by the market cap. We also have a dividend yield of around 1.67%, which we can see here had a very good growth rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 2.4 billion US dollar. This was a decline around 13% from 2019, so probably related to COVID. Then in 2021, we had a comeback with a very good growth rate around 44%. In 2022, we had a very good growth rate again, around 16%. In 2023, a good growth rate again, around 15%, 2024 around 16%. So overall in the last 5 years, I would say we had a very good revenue growth. So the check here, and we like to see that. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 0.08 billion. Then we had a decline around 52% from 2019. In 2021, we had a strong comeback with a growth rate around 252%. Then in 2022, we had a decline again around 1%. But if we're going to take a look at the operating cash flow, we can see we had a growth rate around 9%. The reason for that is the capital expenditures were higher. That's why we had a decline around 1% in the free cash flow. In 2023, we had a decline around 18% in the free cash flow. If we're going to take a look at the operating cash flow, we can see an increase around 10% again. So this means the company investing more money into the business with the higher capital expenditures. We can see here as well, 2024, we had a strong free cash flow growth around 83%. This is very good actually. And we can also see here the operating cash flow increased around 33%. So this was then the capital expenditures stayed the same amount. That's why the free cash flow did grow a lot in 2024. So overall in the last 5 years, I would say we had a good free cash flow growth. So it's also a check here, and we like to see that. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for the undervaluation. So we're going to take the free cash flow from 2024, 0.4 billion. We're going to divide it with the current market cap, 10.82 billion. And then we're going to get the free cash flow yield for 2024, 3.69%. I think it's a decent free cash flow yield, but it's still under the 4% that we are looking for. So it's not a check here. We can also take a look at the future assumptions of the free cash flow. We can see here in 2026, around 397 million, in 2027, around 457 million, and in 2028, around 483 million. So let's assume the number for 2028, 0.48. Then we're going to divide it with the current market cap, 10.82 billion. And then we're going to get a free cash flow yield for 2028 with our free cash flow assumptions. So the number we're going to get would be around 4.43%. I think it's a decent free cash flow yield. Again, it's not very high, so for me, it's not an indication for an extreme undervaluation, but it would be a check here for 2028. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if the company has too much debt and can repay the debt, it can risk to go bankrupt. So first, we're going to take a look at the long-term debt, excluded capitalized leases. So we don't have this here. Then we're going to take a look at the short-term debt. This is around 30 million, so round about 0.03 billion. Then we're going to divide this number with the current free cash flow, 0.4 billion. And then we're going to get the debt to free cash flow ratio that we're looking for. So the number we're going to get is around 0.075. And that's a very good number actually. It doesn't take many weeks to repay the debt with a free cash flow. So it's a check here, and we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. And we can see here, this is also quite a good amount, 176 million. So overall, I think this company has a very good balance sheet, and we like to see that. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. This can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So first we're going to calculate the enterprise valuation. That's the current market cap, 10.82 billion, plus the debt, 0.03 billion, minus the cash, 0.176 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. So the number we're going to get would be around 10.67 billion. So now we're going to divide this number with the current free cash flow. That's around 0.4 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get would be around 26.68. That's a decent number actually. It's still over the 25 that we're looking for, so it would not be a check here. But overall, I think we can also calculate this number for 2028. So with the free cash flow assumptions of 0.48 billion, then we're going to get a different number. So the number we're going to get would be around 22.23. So again, that's a decent number. Actually, now we are under the 25 that we're looking for, so it would be a check here. I think is a fair valuation probably. It's not an extreme undervaluation right now to me. The next thing we're looking for is the shares outstanding decrease. This means the company buys back their own shares. We like to see that especially we think the company is undervalued. So we're going to take a look here, and we can see, yes, this company buys back their own shares, especially in 2022, close to 4%, but also in the last 3 years, we can see some small buybacks. So it's a check here, and I think this company can also afford it because they have a very good balance sheet. Can Texas Roadhouse stock be a good buy right now? The stock price is down around 20% from the last few months. So let's start with a positive about this company. I think they had a good revenue growth in the last 5 years. I also think they had a good free cash flow growth as well, and this is something very important to me. They also have a very good balance sheet, so they have a low amount of debt and a good amount of cash on hand. The free cash flow yield right now is not very high, around 3.69%, but in 2028 it could be better already, of around 4.43% with our free cash flow assumptions. Still not very high to me, but it's a decent valuation maybe. The enterprise valuation to free cash flow ratio right now is around 26.68. We want to see a number under 25. So it's not very good right now. In 2027, it would look a little bit better with our free cash flow assumptions. It would be around 22.23. So probably a fair valuation. The dividend yield is around 1.67%. It's not very high, but we had a good dividend growth rate. The shares buybacks is also very interesting to me, so they're buying back their own shares. This can help the stock price to increase as well. And they have a good balance sheet, so they can afford it as well. So overall, I think this company has a lot of positive. The valuation right now is maybe a little bit too high. So if the stock price maybe goes down lower than $150, I think it could be a good buy. If you found this video helpful, don't forget to like and comment and subscribe for more content.